This episode of the Commercial Real Estate Investor Podcast is brought to you by CRE Launch Pro. This online commercial real estate program is designed to take you from beginner to pro commercial real estate investor with access to all of my courses, our online community, and monthly group coaching calls. Learn how to confidently buy your first commercial property today at www.crelaunchpro.com. Welcome back to the Commercial Real Estate Investor Podcast. For this week's Investors Roundtable, we are diving into creating a recession-resilient portfolio. It's a very on-topic conversation, considering where we are in today's environment. Logan, can't wait to kind of dive into what the Fed is saying as of the last couple of days, because I know you follow that pretty closely. But we're going to be diving into sectors that are more and some that are less resilient during downturns, strategies that we've employed to protect our assets in all economic climates, and alternative asset classes that kind of chug along regardless of the economic environment that we are in, so that you can go out there and invest with confidence. Guys, let's touch first on sectors that are more or less resilient. Historically, what we've seen, your multifamily assets, right? That seems to be relatively recession resistant. How are we feeling about those today? And let's kind of break apart multifamily development and existing multifamily value add assets. Logan, I'm going to throw that over to you first.
Yeah, I mean, Peter Linneman said it best, I think, in his most recent Linneman report. But the best thing that multifamily has going for it is that single-family homes are very, very underbuilt, right? And so that is an underpinning, obviously, a tailwind for the multifamily industry. Now, everyone has been tracking construction starts and completions and forecasted completions. And I do believe we have spoken on this podcast previously about the average for the last 10 to 15 years being somewhere between 250 to 350,000 units being delivered in a year, an annual period. Where we're sitting at in the forecast that I'm kind of looking at is somewhere between 600 and 700,000 for this year. And so there are a couple things to think about on that. One, where is the concentration of those units being delivered? And if you look at the concentration, there's a big concentration in coastal markets and Texas and your guys' great state of Tennessee. And so there's a lot of what you need to do is really understand where they're being built and how that's going to impact that. Still, I don't know how we are going to respond to doubling the number of completions in 1 year. And I wonder what that might do to the asset class just in general from a rental standpoint, right? I mean, these are all likely Class A apartment complexes being developed. And so is that going to put price pressure on the previous Class A multifamily developments? And so it will be interesting to watch. And I think that that's something to keep in mind. People still need a place to live, but they need an affordable place to live. And affordable is a unique word in the sense that that is the definition is different for each individual. 2,500, 3,500 might be affordable for somebody. But if we look at the median household incomes and go back to price to rent ratios, we are starting to see those ratios get pretty high in some markets. Now, that I think has been starting to plateau, and the data would, I think, suggest that rental rates won't be continuing to increase. However, what the other component of the Fed's or the CPI, the measure of what the Fed is looking at for inflation does include is housing, and why housing continues to get more expensive is, well, the new construction homes are more expensive, $400,000, $600,000, $800,000 in a lot of different markets, but the cost to finance those is still extremely high, comparatively speaking, to the last 2 to 3 years. And so that is still pushing up inflation on the CPI, and is why, the Fed has still kind of been a little hesitant to necessarily, I think, really cut rates. But if you strip that out, and maybe we'll talk about this, here soon, but if you strip out the inflation or just the housing sector of the inflation, I mean, the CPI inflation rates are only 1.8% and 2.2%. And so, that might, be something else to be keeping in mind. Where I think places are struggling, I'm speaking from my own example, not really necessarily having Class A in the portfolio, but brokering those deals and knowing what the rental rates are. We primarily have Class C and Class B. Is we still have a lot of traffic for Class C type of apartments, and the rental rates are continuing to push up. However, that market is one that people move a lot. People skip leases. They get evicted, for different reasons, and so you have a lot of turnover in that market, and that's not what's being developed. So what we're really talking about is Class A deals. How's that going to impact the market, and are there enough people to absorb those new units? Well, what type of units are being developed? Are we doing, we doing garden style? We doing high rise? You have to look at that concentration, because someone who is going to buy a house may move into a townhome. They may move into a fourplex if it's really nice. What about a row home? Something along those lines that feels more like a home. That is still to be seen. That's what I'm watching. But I would have to say, just from my prognostication, if we are doubling the amount of completions, that's going to have a pretty good sized impact on specifically those markets that are getting all those new completions here this year.
Yeah, I'm really interested to see what's going to happen in the multifamily new construction market over the next 24 to 36 months, because if you break it down to purely basic economics, supply versus demand curves, right? The demand is there. The supply, on the other hand, hasn't been, which is what has driven up rental rates the way that they have, right? I mean, if we were oversupplied, you couldn't continually raise rental rates the way that we've seen over the last 5, 7, 10 years. Whereas now, if we're going to be delivering this many units, the tenants are going to have all the power, right? We're now in a tenant market. So it's really good for the majority of people. It's really bad for these apartment developers that will be delivering these assets. And you've got to think, at some point, they can't lower their rental rates enough to entice tenants to want to sign these leases without, not being able to hit their debt service coverage ratios or some other aspects like that. So, I mean, I kind of could see an environment where we have a whole bunch of new construction multifamily apartments that are getting, repossessed by banks or are getting bought out of distressed situations. But who knows? There's so much money in that market, as everybody's been saying for the last few years. There's so much dry powder on the sidelines. Somebody will probably step in. Matt, what are your thoughts?
Yeah, I have some similar thoughts. I mean, the development has been heavily in the higher end, including single family, right? It's been higher end development, Class A development for multifamily. And that's because that's where the most profit was, right? So everybody wanted to be in that development. So I'm only in Class C as well, as far as multifamily goes. And I think that's pretty recession resistant overall from my perspective. And then I think the other thing that's important that was also touched on is location is so important in this discussion, because, if you're there's some pretty good supply coming on in Tennessee, but there's also a lot of population growth in Tennessee, right? And then you go into the submarkets, and that's a whole different story. So I think class, affordability, and location are hugely important in this conversation. And if you're in Class C multifamily and you're in a pretty low supply area, I think you're going to be in pretty good shape no matter what's going to happen. If, on the other hand, you're in a downtown or close to downtown, like in Austin, where there's a lot of supply coming on, it could get scary really quickly.
Yeah, you definitely want to be cognizant of that and maybe try and sign some longer-term tenants and give some incentives to do that so that you can weather what's really going to be happening over the next 24 months. One thing that I want to point out too, and Logan, you kind of touched on this as well, construction costs are high. And that's not just in apartments. That is in single-family homes as well. And the multifamily rental market is largely driven by how affordable housing is. If people can buy a house, they're going to buy a house. They're probably not going to rent unless they're moving into a new city and they want to see what it's like there for a year, whatever. Costs are high in single-family residential, and they're not coming down anytime soon. I mean, it's tough to see how, lumber, right? I mean, lumber had its little spike. It came down a little bit, but it's still way more expensive than it was before the pandemic. Once these industries realize, we can charge Y instead of X, they're going to continue to charge as close to Y as they possibly can. They're not going to come back down. And so if single family homes are still going to be that expensive, renting is going to be still the most affordable option for a lot of people, even if it is a relatively unaffordable option. I mean, we've got a housing crisis in this country, and I mean, this is case in point, right? There's not really a good solution anywhere you look, outside of rezoning.
Yeah, and I think we're fundamentally potentially talking about two different issues here. One is the actual supply and demand. Nobody, honestly, I think, knows if we can absorb as a country 670,000 units, even if they were affordable. I imagine we could, but I don't know.
It's true.
The bigger question is we've got a lot of deals that were financially engineered to get completed that are in trouble based off of their debt structure and or the way that they were financed. And I think that is the larger concern is, will they have to just step away from those at par or take a loss and let somebody else come, scoop it up, right? And so I think that's there's two kind of issues here that we might be speaking about that have different factors that are driving both of them. And, on the latter part, financial engineering side of things, I do believe that, I just checked before the call here. There is a lot of dry powder, not just allocated for real estate, but in money market accounts alone, United States Americans have $6 trillion. And, stock market, we can talk about that, has blown up since October of 2022, 44%, and continues to reach all-time highs. Bitcoin continuing to reach all-time highs. And so that money market account funds are likely going to start chasing more risk assets. And so whether that be real estate, whether that be, the stock market or other valuations, but I frankly don't know how that's going, to play out. And I'm very curious to see it, but that is something to think about. Americans have $6 trillion in money market accounts alone. And the big funds have a lot more trillions than that ready to go for real estate assets. So that could, like we said many times here on this show, kick the proverbial can down the road just a little bit longer, but we'll see.
Yeah, that's the important thing to point out, is that that's what makes this so complicated. Nothing is in a silo, right? You can't just say, this is the only factor that matters. There's going to be a dozen other factors that you have to take into account and then figure out how they all are going to work together, which makes it that much more complicated. Let's get to number 2 on our list, which is healthcare real estate. Healthcare real estate has, look at what happened during COVID, right? Doctors' offices did phenomenally well. No matter what kind of an economic climate you're in, people need their healthcare, right? They've got to get their teeth cleaned. They may do it a little bit less often than typical, but they still have to do it. They've got to go get their annual checkups, still going to the hospital. Matt, what are your thoughts on healthcare real estate moving forward?
Yeah, I don't have a ton of experience of this, but in our affordable office space, we have a fair number of tenants who are healthcare products, counseling, insurance paid tenants. And I've always felt like that was a pretty nice recession resistant tenant base. It's hard to imagine a scenario where that doesn't remain relatively stable, right? I think you still got to consider vacancies in the area, right? Because the healthcare may relocate and that causes stress on your asset. But as a tenant base, it's pretty safe. It's pretty straightforward. I don't think there's a lot to it. It's hard to imagine why that particular tenant base is going to struggle moving forward.
Yeah, I would agree with you. Logan?
Well, I've got some thoughts on this, and the first one I'll start with is Peter Linneman again, and I thought this was really interesting. Watching trends, hearing people taking drugs like Ozempic and things like this, to help weight loss. So one of the things that he mentioned in his letter was that Ozempic and other weight loss drugs could save the United States 2 to 3% of GDP in an overall healthcare spending. And that 70 to 80% of all medical spending is somehow related to associated being overweight. But that still doesn't mean that we are getting younger. We are getting older. And so I think healthcare, specific types of healthcare, could do very well. And, one thing that maybe you and I will touch on later in the month is one of our brokers here does focus on healthcare real estate. And last night at my oldest daughter's, soccer practice, I'm talking to one of the 7 banker dads there, and I'm like, "What are you guys working on?" And he goes, "Well, our overall spending, our overall budget for the bank this year to outlay is $40 million." And I looked at him and I kind of said, "Was that maybe your quota, 2 years ago for yourself?" He goes, "Not even." And I said, "Well, what are you lending on?" He's like, "Healthcare owner user type of real estate." And so that means I think that we might start seeing trends like older office product that is single story, maybe next to a shopping mall or something along those lines. It could be a retail space as well, searching out and focusing on healthcare tenants, because one really interesting value add strategy is to take an old office building and repurpose it, if possible, if you can get the basis low enough to attract those healthcare tenants. And, we've signed 2 different dentists in our shopping centers here recently. And yeah, it takes a lot of money to get them in there. And, but they typically, sign 7 to 10 year leases. They're doing a major build out themselves. They're building their clientele, and they don't want to leave because it's really expensive for them to leave. And so I frankly think that that's a really unique, interesting opportunity for folks that might have an in with tenants and or that business model to be able to drive traffic from a tenant and business perspective to go add value to older shopping centers, older office buildings. And of course, if they're specifically around a hospital, even better, right? And that's where I think we're starting to see that, because you take an older office building, and maybe let's just talk about a single story office building that has 4 to 6 spaces in it, and you put all medical tenants in there. You might have just taken the cap rate from an 11 to a 6 or a 7, once it's done. So that could be a really interesting strategy for someone that might be interested in adding value in a unique way. Overall, though, I think the space is quite resilient, but again, it just kind of depends on location on that asset class, and then what else it can be used for. Because just talking through, a multi-tenant or multi-story office building and saying we're going to turn this into a dentist or a medical office building, it's a lot harder than you might think. And so, I frankly haven't seen that many dentists or chiropractors or physical therapists on 2nd, 3rd, and 4th floors of buildings. Think about that, right? We're talking about real estate here. If you're a physical therapy company, do you want your clientele having to get on an elevator or maybe even having to use stairs? I don't think so. They're probably there rehabbing an injury, right? So, and I've never been to a 2nd story dental office too. Maybe that's different, outside of Kansas City, but typically I just walk in and go to the dentist's office, and that might be because they don't want to move all that equipment up the stairs.
Yeah, the only time I've seen like 2nd floor dental orthodontics is in, high density shopping markets, right? So like Green Hills here in Nashville, there's a lot of shopping going on there. And, my orthodontist, this was way back in the day, but he had the full 2nd floor of this building because there was a bank that occupied the entire ground floor. And it was, back then it was Class A. It had to have been considered like Class AA back then, but nobody called it that. It was really, really nice. But yeah, I agree with you. I love the idea of converting older office buildings into medical office space. The biggest thing, like you pointed out, you've got to get a really good basis on it because it's unbelievably expensive. And you may not even know what to do to that building to convert it into medical office space because it's going to depend on the user, right? As in the heyday of my brokerage, when I was brokering more than, doing investments or, running a YouTube channel, which is a very interesting career path for me now, I was, the guys that you wanted to work with were the dentists. They come out of dental school and Bank of America is like, here's $400,000. Please open up your own dental office because they don't fail. They get all this free money thrown at them. They have all of these resources. And they're great tenants to have. But, we've been getting a bunch of calls at the brokerage here lately. I don't know if it's because we've been talking about it on the podcast or what, from investors wanting to buy medical office buildings. And the problem is everybody in the country wants to buy medical office space now. and cap rates are still really low. So it's you really have to do your own, right, if you want to get the yield that's going to be attractive. We got a comment from Kyle. Between high construction costs and interest rates floating around 7 to 8%, which do you see having the longest impact on investing moving forward through 2024 as well as years to come? I mean, in my opinion, it's going to be like the longest impact is going to be construction costs. I can see interest rates coming down in the next 12 to 24 months. And, the great thing about interest rates is you have an immediate impact on the volatility of the market. Whereas construction costs, I just don't see them coming back down. I think that we've got a new reset. This is how expensive things are going to be moving forward. And so now we've got to just kind of adjust to the market. Matt, what are your thoughts?
I kind of agree with you, but I can also see the other side too, where maybe it could be interest rates because, construction costs are in line with inflation. They're in line with overall costs. They're, basically in line with the dollar becoming weaker, right? So that's kind of balance out across everything. Whereas interest rates, if we're going to see higher interest rates indefinitely, even if they go down a little bit, presumably they'll be higher than they were for a while. Well, that's going to impact a lot of things. That may impact cap rates for an asset class for the next 20 years, right? So that's one way that I could see the interest rates really making a significant impact. We're in a price discovery phase right now, right? Where not a lot of things have moved. We don't really know what the proper cap rate is for a lot of assets in certain locations. We don't know what the proper prices are for a lot of things. And I think if we settle at a high, if we settle at a significantly higher interest rate across all asset classes, then depending on how it all shakes out, we may be, these 5 cap buildings may be trading at 7 caps for extended periods of time, right? So I'm not sure. It could go different ways. And I guess it's a little bit of a loaded question because it depends on how long these rates are high, right? If they go back down, well, then maybe it doesn't have a big impact for very long. If they keep going up, maybe it gets really ugly for an extended period of time. So I could see it being either way. I'm just afraid that it's going to take us a while to see how dramatic the shakeout is from the interest rate jump, just because there's so many purchases have been made off of these projections, and so much money has flooded some of these markets based upon cash flow that will not be there anymore. Right. A lot of these assets are going to negatively cash flow for the indefinite future based on how they were bought in the last 5 years. So we'll see. I could see it going either way, I guess is my answer.
Yeah, it's interesting. Logan, what about you?
I think that interest rates are obviously a main component to making deals pencil. However, construction costs, that is not just these supplies, right? The goods that are needed to create these. It is also a function of the labor that is inputted into that system. And so that's a larger conversation because, that's hard to create just skilled labor out of thin air, and that's not something that I think is happening. And so that might be a bigger factor in the long run is how do you actually get construction costs normalized and or down? What I think actually happens is, interest rates come back down and people have money. And so the returns look like that something they'll be, okay stomaching. And so then they're okay with the new construction costs, right? And the other component is to think about is, well, if it's so expensive to build new, then what does that do for existing assets in regards to demand? It probably goes up. And so if that happens, then what happens to the actual prices? Well, why would they come down? I don't know why they would come down anytime soon. If the demand is still high and you're able to push rental rates, your NOI is going to be able to continue to increase potentially. And so then if we're talking about a multiple on capitalization rates, then where do cap rates kind of shake out at? Well, I think that the one component to that, or factor or variable that can be solved, is the financial engineering once again. So you might start to see more investors buy cash and say, I'm going to hold on to this for longer and just buy cash and wait for the interest rates to come down before, the continued prices might continue to go up. As you know, I study the 18.6 year real estate cycle, and I have no inclination that commercial real estate prices are going to drop, through the roof until sometime in 2026 is my kind of thought process right now. And I would say that the 18.6 year real estate cycle is playing out very well in regards to other assets continuing to climb in price. I mean, look at the S&P, look at Bitcoin, look at the NASDAQ, look at Japan's stock market. I can't even pronounce what it's called. Look at Germany's all-time highs in all of those. So I also follow Ray Dalio very closely. And Ray Dalio kind of put out a report just recently saying, I don't even feel like we're in a stock market bubble yet. So the thing that Howard Marks always talks about is, are we in a point where it's irrational exuberance or rational exuberance? And right now, it doesn't seem like anything's slowing down from that standpoint. Obviously, artificial intelligence is really pushing a lot of these companies forward. I mean, the numbers on the market cap for NVIDIA are just unbelievable. It took them 25 years to be worth 1 trillion in like 3 months or something like that to be worth 2. That's when I'm starting to say kind of, wow, we're kind of getting into a point in time where it's like, man, that's crazy. But the reason I'm looking at that stuff is because commercial real estate's a lagging industry, right? And so what's happening in other asset classes is probably and likely could roll over to commercial real estate at some point. And let me be clear, there will be losers. There already are losers in asset classes. We've already discussed that, I think, on this show multiple times. But I kind of wonder the bigger overarching cycle and theme, how that impacts commercial real estate. And maybe that's tied for, perfectly when the Fed, cuts rates, and then we start to get a lot of players back in the market. So it's just, it's kind of mind boggling just to try to think through and try to understand. But if you can step back and take a bigger picture view of it and try to look at other asset classes and what's happening there and say, maybe that's going to rub off on commercial real estate a little bit. I think that's where a lot of people have a lot to gain here in the next 2 years.
Yeah, I think that's pretty interesting. Kyle, I'm going to give you a different take as well. I mean, this isn't really quite what you're asking, but between the two, higher construction costs being high could actually have a more positive impact overall in the commercial real estate industry. And I say that because construction has been relatively cheap for 30, 40, 50 plus years, which means that we haven't innovated in the construction industry for 30, 40, 50 plus years. Now, there's been a lot of talk about modular construction, SIPS construction, creating these manufacturing facilities where we're actually building the majority of these components within warehousing. And it's been more novelty than anything else. And when construction costs are as high as they are today, I think some bigger money is going to start taking, manufactured construction a little more seriously. And I would love to see that because it would be so much more efficient. I mean, come on. I know I've said this on this podcast before, but can you imagine if you ordered a car and Ford showed up, dropped all of the pieces in your driveway, and started sending people out to assemble the car right there? It makes no sense at all how we build houses today, at all. So we need to fix that. Okay, last one on this list. I know we're kind of burning through some time here. Last one on the list of relatively recession resilient assets is grocery anchored shopping centers. I love grocery anchored shopping centers, even through the 2010, 2012 era when everybody was terrified that retail was dead because of Amazon. Grocery anchored shopping centers did really well because they are serving the daily, weekly needs of families, which means that they are bringing those customers in multiple times a week, and other retail tenants that want to kind of, survive off the crumbs, right? The remoras of these giant groceries. They want to, continue to be in these shopping centers, and they're doing pretty well. So, Logan, I'm going to lob this over to you first. What are your thoughts on grocery anchored shopping centers moving forward?
Yeah, well, the biggest thing to think about when you're underwriting these projects, and if your cost of capital is cheap enough to go compete with the larger institutions, kudos to you, because they are low on the cap rates because of this. But you always want to check what is the market presence look like online, because a lot of these retailers and shopping centers are really focusing on an omnipresence type of business mentality, which means they've got to be able to have some sort of online presence. They need to capture your information. They need to be able to market to you with coupons. It's kind of weary. Like, I was in Target with my wife the other day, unfortunately, and when I left, 2 days later, I got a mailer from Target that, was really focused on, diapers and things like that. And I'm like, man, were they tracking where I was when I was in Target, or how did they know that anyways, that's to the level. I'm not going to get conspiracy theory, but that's to the level that I think that national retailers like Target are tracking you. And it's probably because my wife has the app and they got some geocode on her app or something like that. And they actually do know where we're at. And she probably, said that's okay when she signed up for it. But regardless, I think that's really important for, grocery stores, because a lot of people are buying online, picking up on the curb. They might have shoppers now. I mean, I go to the grocery store and people are out there and they've got, Hy-Vee on their shirt, and they're just shopping away, putting stuff in the cart. Or I haven't bought groceries at a grocery store in a long time. We use, what is one of those apps that sends me my groceries?
Like
It's not
Instacart?
DoorDash, but Instacart. Yeah. I mean,
Yeah.
we just have Instacart straight to our house most of the time. Taking 3 kids through a grocery store is like that's a
Oh, yeah.
no-brainer. We don't do that. So at the end of the day, I think it's really important to know, does this grocery store have a online presence? Are they, in what percentage of their sales are online versus in store? That's really important. That being said, there's different level of retailers as well, right? I mean, if the traffic counts and you're on Placer.ai, and their traffic counts and or the people counts are not where they want to be, they will move, they will leave, and you are stuck with a large building with a grocery store footprint that is very difficult to fill in some scenarios. And so what I have been seeing, and I think is really cool, is smaller footprints. And so starting to see these grocers kind of test out smaller footprints, going into more suburban retail shopping centers, and cutting their footprint in half and testing that out and seeing how it's going. And I think that's a really cool opportunity for investors because of what you mentioned earlier, the cross-pollination of people coming to that grocery store. So, but I've looked at a number of grocery anchored shopping centers, have never been competitive on those. It really is going to be a coupon, and you're looking at the lease and the guarantor and making sure that that person or that company feels really good about being in that location. But man, I will tell you what, people don't stop eating during recessions. They don't stop going. In Kansas City, I still remember wearing my mask and going and picking up my groceries, because we didn't know if we needed to spray down all of our groceries after somebody delivered them to us, or that might have not even been an available option for us at that time. So I think it's a great asset class to be in. If I'm an investor, I'm likely looking at a mid to large size operator who has 25, 30, 40 of these that can bring some pricing, prowess to the deal, and see if they have the ability throughout their other shopping centers, if they do leave, to be able to backfill that space really quickly. So wanting to have national, relationships with those tenants so they can negotiate really well with them. And lease structures, as you guys both know, I'm sure are very important to review, understand. CC&Rs in regards to grocery stores can be somewhat strong sometimes, because they do now sell clothes and they sell flowers and they sell sometimes shoes and random stuff like that. So all things that are pertinent to looking at one of those deals.
Yeah, I mean, I remember dealing with Kroger back in the day. They were in a shopping center that we were leasing. And, Kroger, of all places, had a restriction on bakeries. In this 550,000 square foot shopping center, we couldn't put a cupcake shop because
Yep.
Kroger had a restriction on that, which is, I get it from Kroger's perspective, because they're going, well, hey, we are the anchor here. We're occupying the most space. We're going to bring the most traffic. We need items like this. But man, to knock out a 1,200 square foot cupcake shop because you're a grocery store is a little wild to me. But Matt, what's your take on grocery anchored shopping centers?
Yeah, I mean, in general, I guess I like them. I had a deal under contract we didn't go through because this was when the interest rates were going crazy while we were under contract on a retail space shadow anchored by a Target, and I generally like them, and you can see why they're recession resistant. Obviously, people need to continue to buy groceries, but as an investor, they kind of scare me at the same time, right? And it was hinted at earlier. You've got these large spaces that are mostly designed for this use with a certain amount of parking spaces, and they've got these covenants and restrictions. You certainly got to be very careful when you buy these sorts of properties. You need to review the leases and the restrictions very carefully. And I guess for me, I have a very personally, I understand why people would want to buy them, but I have a very simple philosophy as far as recession resistant purchases, which is I want to buy affordable stuff, right? And so that's the other trick for me is I don't love the idea of buying something that's already been leased up as a shopping center, and you've got the shadow anchor tenants, and you're hoping they renew, and you're buying it at a lower cap rate. And then if they leave, you have a lot of liquidity events to turn these units over. So I don't love that aspect of it, actually. I would personally prefer to have my assets be something that's affordable, below replacement costs, flexible. There's a lack of flexibility, and there's a high risk of liquidity that comes with some of these things should the tenants not renew, or should the restrictions cause you issues when you're trying to replace tenants leaving. And that, I think that's only going to be potentially exacerbated too with so many things are changing so quickly with technology and with how people shop. And it's really hard to predict what that's going to look like in 10 years. So now all of a sudden you add that layer on top of the restrictions and the leases. And in 8 years, you have a few tenant spaces come vacant, and you don't really know what the tenant landscape is going to look like at that point, but you've got an anchor tenant with all these restrictions in your lease. You don't know what that's going to cause for those spaces, if that makes sense. So to me, I understand why people like them, and I have nothing against buying them. But personally, I would prefer a more affordable and flexible asset.
Man, leave it up to the attorney out of the three of us to come up with all the potential bad scenarios of having. I love that, man. That's why it's so helpful. Make sure you have an attorney whenever you are buying real estate. You've got to think through these things. I mean, it's a good point, right? Like, a lot of investors are willing to put up with that, but there are potentially some scenarios out there where that actually really comes back to shoot you in the foot. And the other thing is too, like those CCRs, like funny enough, can almost be like a self-fulfilling death cycle. Because, Kroger or not, any grocery store could have restrictions that basically say, hey, we don't want any of these kinds of tenants. But we also have a co-tenancy clause where if you hit a certain amount of vacancy in the shopping center, we can cut our rent in half or we can vacate. Well, if you can't fill any of those spaces because the only tenants that will want to lease from you are tenants that they are restricting in their lease, you could end up in a really bad spot.
The other thing, real quick, the other thing on that is, as these building age, you see some of them, they used to be grocery centers, and they've got the urban air, the trampoline parks and you walk into what looks like 19,
and gyms.
Churches and gyms. That scares me too, because it's to me, I hate the idea of being 20 years into that asset, and you're kind of in one or two situations, which is your remaining lease terms are shortening, right? Which makes the asset less attractive, or the tenant you can put in there becomes less and less viable, right? So, I don't think we've really seen the full life cycle of that yet play out and what that looks like after these urban airs leave. So that's something I think would be fun to watch and see what happens with those buildings, because I see a lot of buildings that feel like they're kind of hanging on their last legs that are being supported by unique tenants in these large spaces.
And by unique tenants, you're saying advanced check cashing and vape shops and
Yeah.
yeah, what a euphemism right there. Real quick, for the sake of time, we'll just nail these three that are the least resilient. And if anybody has anything to discuss on any of those three, let's do it. Hospitality. So like travel and leisure, typically impacted by economic uncertainty, which is interesting. We kind of had the opposite effect in COVID. People wanted to get the hell out of their house. Luxury retail. Discretionary spending tends to decline during recessions, and speculative office space. I don't think anybody is remotely surprised at that being an issue, and there's probably nothing more to be said about that. Anything else on hospitality and luxury retail, guys?
All these guys with all these, short-term rentals scare me too. And
Yeah, short-term
I've been
rentals.
worried about that for years. I mean, especially because they're, a lot of them have been underwriting the real estate as if they were a business, right? So they'll take a single family home asset, what would typically be a single family home asset, and treat it like it's a commercial property or a business, right? And they'll look at it and they'll say, okay, well, this made $100,000 in income, and we all know that none of this, not even all of this, is even true, right? Maybe it didn't even really gross 100. That's what they put on the piece of paper. And here's your, short-term rental manager's projections. We're going to do 130 next year, and so based on that, this single-family house is worth $1.5 million. That is a scary asset to be buying because the underlying fundamentals of the real estate itself, perhaps that house on a comp sale would only sell for $500,000 and you're paying 1.5. That is a scary asset class to be in my opinion. And I just would want to be getting out if it were me. Unless you could show some real sound fundamentals that you can rely on that income. And personally for me, unless you can show that without this business income, the underlying asset is worth a similar amount. That's the opposite of recession resistant to me.
Yeah, in my opinion, you've got to be the 1% operator in Airbnb. You've got to be the person that knows exactly how to do this. You have to be the person that knows how to create a very unique experience. And 99% of properties out there are not that. It is rinse, wash, and repeat. There is no differentiation between your house and the house next door. And once you start adding all the hidden fees, I'm going to a hotel, right? Unless I'm like wanting to book a 10 or 12 person cabin. The other thing that I want to say too, and you heard it here first, the lowest cap rate that an Airbnb should ever trade for is 10%. The 1% operators, sure, yeah, you could probably push that lower. The overwhelming majority of Airbnbs are worth a 10% cap rate or higher. Everybody has been lying to themselves over the last few years. They are very, very management intensive, which is why it trades for a higher cap rate. There's just more work involved. Multifamily apartment complexes trade at 4.5% cap rates because I know I don't have to do a damn thing. It runs like a well-oiled machine, and it's going to continue to do that. And I'm buying that for that. Airbnb is risky. Logan, what are your thoughts?
Well, we have recently in Kansas City and other submarkets gone through a big change in Airbnb regulations, and they are just crushing operators left and right, saying, "Hey, if you didn't get your permit 2 years ago, you're shut down. Hey, this submarket right here in this neighborhood, we're just shutting it down." And so, I do have about 25, 26 of these in Kansas City, but they are all either a true bed and breakfast hotel, or they are, in a mixed use building where the highest and best use legitimately was to be residential on the second floor, third floor, because we're not getting office or anything up there. And they're in high trafficked entertainment districts where people want to kind of be. But from the management standpoint, completely agree on that front. So the ones that I do have a little bit of diversification of income. They might have a commercial tenant and then residential on top, or they've been operating as a true bed and breakfast hotel, which is just a little bit different as well. So I think that's really scary too. From that component is just having your local municipality say, nope, we're not doing Airbnbs here anymore. You got to shut down in the next 30 to 60 days. And, just like you said, now you've got a $1.5 million debt obligation on a $500,000 house, and that's a really tough spot to be in.
Yeah, you really want to look at the valuation on a price per square foot basis if you're going to buy an
Yeah.
existing Airbnb. It's the same thing with triple nets, right? You don't want to go buy a Starbucks at $1,500 a square foot just because they've got a really nice lease. I mean, a lot of these tenants have 2-year kickouts, right? And if they don't perform, then they get to just walk away from the lease. And now you paid $1,500 a foot for something that's probably worth $500. I mean, it's the same thing no matter what asset class you're looking at. Okay, Orpheus, I saw that you've got a question. We'll get to it here in a second, brother, but I want to make sure that we get into the strategy behind what we employ or deploy on our assets to make sure that we make them recession resistant. I'm hesitant to say recession proof because there's always something that comes along like COVID where nobody could have possibly anticipated that. And, as great of investors as we all would like to think of ourselves to be, there's things that just happen, right? So I'll kind of kick it off while you guys are thinking through, what are the specific items that you do? The first thing I do is I underwrite everything unbelievably conservatively. I beat the hell out of the numbers to make sure, okay, in a worst case scenario, am I able to get my investors 8%? If we only get this to 60 or 70% occupancy, if I'm only able to get 80% of the rental rates that I think that we're going to get, if it takes me 12 months longer to finish construction on this asset and actually get it leased up, are we able to cover our debt service as we're going through that process? So I really do beat it up. I mean, to put it, here's an example right here. When we were underwriting our hotel, we were working with other professional consultants on this asset because it was the first hotel we did, and I like to make sure I get things right. And they were saying that on the exit, we're likely going to be able to hit a 6.75% to a 7% cap rate, probably more aggressive. I underwrote it at an exit of an 8% cap rate. I don't care. Like, that's great. It would be amazing. I would love to hit a 6.75% or even a 6.5%. But I'm not going to bank on the numbers that I'm going to tell my investors at 8% because look at what happened today. What if I was trying to sell my hotel last year? We would have been very happy to get an 8%. So you always want to think through the worst case scenarios as you're going through that. The other thing too is you are leasing to tenants for the downturn, not for the cash flow. And I say that because a lot of landlords I've noticed will take any kind of tenant that they can just to get the cash coming in. We scrutinize all of our tenants through, multiple different layers. Like 1, how much cash do they have on hand? 2, how well do they operate? 3, if a recession hits, if they lose business, will they be able to continue paying this rent? And, there's a lot of risk that we take on as landlords by putting capital into these buildings and signing leases with these tenants. You don't want to have all of that money invested, all of that time, all of that effort on a tenant that could just disappear overnight and walk away completely unscathed, leaving you holding the bag as a landlord. So those are a few things that I do to kind of make my investments more recession-proof. It's not foolproof, but I'll tell you this. When we went through COVID, we had a less than 3% default rate. And that default rate wasn't even necessarily full defaults like they disappeared. It was more of, hey, we need a couple of months to catch back up on our rent. Will you work with us? Absolutely, we will. So it's because of those two things that I said there. Matt, what are your thoughts?
Yeah, I mean, you touched on a lot of great things there. Corporate guarantees, personal guarantees are enormous, and it's amazing how many mom and pop landlords don't pay attention to that. Hugely important, and that ties to the credit worthiness, right? You need to know that somebody is able to pay your rents and the remainder of the lease, no matter what happens, and that ties to a great lease. It's, especially the smaller the tenant, the more mom and pop type of tenant, the more aggressive the lease should be in your favor. So that's another aspect of that. You need to have a pretty aggressive lease, the riskier the tenant is, right? You're not going to get away with that for a Starbucks, but if you've got the paint company, a local painter who's renting your space, you better have a really good lease in your favor, right? So those are a couple things. For me, I mean, I say it again, it mostly comes down to buying it right? For me, when I buy it, I want to be able to envision the worst case scenario. And, it's a little bit different because I'm pretty much holding everything I'm a part of or have the ability to hold. you may not have that luxury if you're having to return capital within a certain time period, right? But from that vantage point, I want to just make sure I know that no matter what happens, I'm never forced to sell anything, right? So that's a simple way I think about it is with this purchase, if the interest rates go up, if I get some prolonged vacancy, if I have CapEx problems, can I hold through that to the other side without a doubt? And if I can answer yes to that question, then I know I'm going to build wealth indefinitely, right? it's and if I don't ever find myself in a situation because of vacancy or interest rates or lack of cash flow or lack of liquidity that I don't have to sell something at a lower price than I would like to, I'm going to be fine. So I know that's a simple perspective, but it helps me create a framework where I'm looking at the worst case and making a decision based on that on the front end. And then throughout, of course, you got to put all these safeguards in place to your leases, your credit worthiness, all this stuff to ensure you're maximizing the upside and limiting the downside.
Love it. I think that's smart. Of course, the attorney coming in with the guarantees. I got asked the other day, why would I have somebody that has an LLC personally guarantee a lease? And, to us, we do this every day. We're like, well, that's so obvious as to why I would do that. But to a lot of new investors, they don't think about that. They're like, well, the LLC is signing on it. Here's the thing. LLCs can be dissolved overnight and people can walk away, or they could just be left there and they're limited liability companies. You can sue the company, but you can't, they're not going to pay you rent. You want to get a personal guarantee because then that person, the only way that they can get out of paying the rent is by filing personal bankruptcy. Most people are not willing to take that drastic of a step. And so it protects you to at least bring them to the table to negotiate with you on getting out of the lease. So very important to get personal guarantees. That's a great point. Logan, what are your thoughts?
Yeah, I think you guys hit the main ones here. Going third after you two geniuses is a little bit tough. But at the end of the day, I think that one thing to kind of keep in mind is recession resistant your capital structure. I had a mentor of mine. This was pre-COVID. He was kind of going in. He was looking at. And he has about 65 single-family homes and another 50, multifamily buildings and some other stuff. And I'm like, "What are you up to this time? It's hard to, buying any deals." And he's like, "I'm going through and I'm locking in debt right now because I don't know what's going to happen." It was already on its downward trend, right? But he didn't wait till it got to 3%. He went ahead, locked in 4% and felt very good about that because he went from 6% to 4%. So he didn't get greedy, and he had no inclination, no reason, no need to have to think about selling anything during a downturn. So if you feel like something is coming and you think that there might be tougher times ahead and you're in a position to potentially go lock in some fixed rate debt or refinance your asset at this time, that might be a good thing to think about. And what we try to do is a quarterly hold sale refinance analysis on every single asset to kind of see where we're at in the position. Sometimes you can't, right? And it's just like, okay, we don't have an option here. But if you do have a few assets and you have options, definitely something to think about to limit your exposure in regards to maybe a downturn. And then on the multifamily side, if you are operating in, class B minus C, D type of locations, just making sure that you step up the tenant communications and the resident communications of available options to them while they might not be able to find work. Whether that be if you're, got an apartment complex next to a warehouse, can you go, canvass the warehouse and talk to all the tenants there saying, "Hey guys, are you looking to hire? Man, we are trying to hire so much." Okay, you have some flyers. Now the flyers are at under every single resident's door. Things like that. Other rental assistance programs that you might have access to. So making sure that your team is up to speed on that and being proactive is also another measure that you can take to try to get in front of a big wave of vacancy on the multifamily side.
I love it. Great points all around, guys. The other thing is too, when you're buying real estate, buy it for the recession, right? It's very easy to get caught up in, oh man, real estate's going up 10, 20% year over year. It's never coming down. It comes down. It might not necessarily come down in a way that you're expecting it to in terms of maybe valuations, but look at what just happened with interest rates. There's a lot of guys that thought, oh, I'm just going to get an adjustable rate mortgage on this $50 million multifamily asset. It's, real estate's hot. It's never going to go up. Well, guess what? Who was that? Was it the Nightingale portfolio out of Houston? The guy went from like 4% interest to 8% interest within like 3 or 4 or 5 months, something crazy. Gave the keys back to the bank and walked away. Lost all like several $100 million. So you don't want that to happen to you. Orpheus is asking, being a property manager, I'm trying to keep up with dinner table talk with my broker father-in-law and developer brother-in-law. Do you all have any suggestions on material to read and keep up? Man, that's a hell of a dinner table to be sitting at. Let me tell you what, you're at the right table. I mean, Captain Kurt's over here like, dude, you're sitting in the right room. I could not agree more. I mean, Orpheus, right off the bat, I'll tell you, I always want to be the dumbest and the poorest person in the room. Because if I'm checking those 2 boxes, that means I'm surrounded by some awesome people that I can learn a whole bunch from. So you're in a good spot. Matt, what are your thoughts?
I was literally thinking the same thing. I'm like, he said, how do I keep up? I was like, don't worry about keeping up. Be happy that you're at the table with somebody you can learn from. But the other thing too is everybody's got value to add, right? So just think about how you can add value. If you've got property management background, I guarantee you've got value to add on that. So don't try to be something you're not. Just add the value where you can.
Logan?
Yeah, I think that there are some really good books out there. As I'm bringing on kind of newer team members that may not be as familiar, I found a good overview from CrowdStreet. I've got the book sitting right here, but anyways, look at CrowdStreet's commercial real estate book. It does a really good job diving into probably what the developer and the broker are talking about, how to structure deals. It dives into different asset classes, breaks down IRR, NPV, ROI, AAR, all of the different return on investment calculations. That's really helpful. It's an easy read, and it's a relatively cheap one. So that's a good one to kind of start. And then, podcasts, just like you're doing right here. I think that's huge, right? Hearing people talk about the game. And so obviously we've got, there's hundreds of thousands probably now podcasts to go, check out and review. So I think education is crucial. If you're a property manager, maybe looking into other designations through the National Association of Realtors, maybe that's CCIM or Certified Property Management. I'm sure they touch on some of those things as well. So always leveling up and finding some, different educational sources is great. I use Audible all the time. Right whenever I get off this call to go pick up the kids, I'm going to put on probably an Audible book and start listening to one. So I think that's a great time, great place to do that. But also, as you're spending time with them, don't feel bad about asking a question. If they start running through, hey, I got this three-year refinance. I'm going to pull the cash out. I'm going to buy this. I'm going to do that. Say, hey, talk to me like I'm an eighth grader and just break that down for me. Because tell me a little bit more about that. I would not feel bad about that. They're not going to look at you like you're an idiot or anything. You're just trying to learn and be able to kind of add some value to that conversation. And people love to be asked questions if they know something and explain it and tell you about it. So I think I'd take that approach as well.
Yeah, I'm gonna reemphasize that. Ask the damn questions. I genuinely love. That's one of the fun things about doing this podcast live is because people jump in and ask us questions, and we love answering them because it's fun, right? Like we're 10 plus years into our careers here in real estate. We forget what it's like to be at the very beginning sometimes, and honestly, like it kind of brings me back to like when you're asking that. The first thing that came to my mind was when I was sitting in my old boss's office and he's talking about all this stuff and I'm like, what in the hell is happening right? This is a different language, so it's kind of fun to reminisce on that. So yeah, ask the questions, man. You're in a great spot. Well, that brings us up on the hour. Appreciate you guys for joining us for how to build a recession resilient portfolio. We keep these live every Wednesday at 3:30, every other Wednesday at 3:30 p.m. Central Standard Time. So come back and join us, ask your questions live, and we will see y'all in the next one. This episode of the Commercial Real Estate Investor Podcast is brought to you by CRE Launch Pro. This online commercial real estate program is designed to take you from beginner to pro commercial real estate investor with access to all of my courses, our online community, and monthly group coaching calls. Learn how to confidently buy your first commercial property today at www.crelaunchpro.com.